It's 11:40 at night and I'm doing the math on my phone for the fourth time, hoping I did it wrong. 14 years. Not 14 years of saving. 14 years of my entire salary, every dollar, no rent, no food, just stacked to afford a normal house. I called my mom about it, half joking, and she got quiet. She and dad bought their house at 28. 3 years of what they made, maybe four. Same country, same dream I keep chasing. Completely different math, and nobody in my family ever explained why. Everyone's advice is the same. Budget better. Automate your savings. Stop buying coffee. Like the gap between 3 years and 14 years is a latte problem. Like I could skip enough lattes to erase 11 missing years of income. That's not a plan. That's a distraction, dressed up as one. Here's the number that actually kept me up. The stock market has averaged something like 10 to 11% a year for decades. My savings account pays basically nothing, less than 1%. Rounding error money. I'm not behind because I'm lazy. I'm behind because of where my money is sitting. Okay, so the obvious question is, why is the system broken? But that's not actually the question I need answered at 11:40 at night with a calculator open. The real question is what happens to me, specifically, while I sit here waiting for it to fix itself. Because waiting isn't neutral. Waiting has a price, and it compounds quietly while I'm not looking. I actually sketched something in my notes app to make sense of it. Picture two escalators side by side. One goes up, one goes down. That's the whole shape of what I've been circling around for weeks, and once I saw it that way, I couldn't unsee it in literally every financial decision around me. The up escalator is assets, stocks, real estate, a business, anything that makes money while you sleep. The down escalator is cash, wages, a savings account, anything that quietly loses value while the other side of the room keeps compounding. I wrote both lists out and just stared at which one I was actually standing on. Here's the part that scared me. Both escalators look identical from the entrance. Same color, same speed, same crowd getting on. You don't find out which one you stepped onto until 5, maybe 10 years in. I checked which one I was on 4 times that night. 4? I still wasn't sure. This isn't about effort, which is the part 1 didn't want to accept. Someone on the down escalator can work twice as hard as anyone and still lose ground every single year. Someone on the up escalator can basically stand still and win. That's not motivational. That's just physics with a bank account attached. So when people my age get called lazy or entitled for not owning anything by 30, I used to just absorb that. Now I don't. What actually happened is structural, not personal. The rules that decide who builds wealth changed underneath us before we even understood there were rules to learn in the first place. I went and actually looked into why instead of just feeling it. From around 2008 to 2022, interest rates stayed low for almost the entire stretch. Cheap money means people borrow more, pay more, bid more for anything that earns income. So every asset quietly got more expensive while I was still in school. It wasn't just regular people either. Big institutional money went hunting for returns and poured into stocks and real estate because cheap borrowing made those the only places worth putting cash. Every dollar that flooded in pushed prices up further, and none of that money was thinking about a 22-year-old trying to get in later. Meanwhile, wages for most people, the bottom 60% of earners, barely moved once you adjust for inflation, nearly flat for 2 decades. Asset prices over that same stretch roughly tripled, sometimes quadrupled. That gap, not rent, not student loans, is the actual number nobody sits you down and explains before you turn 18. I almost didn't write the next part down because it made my stomach drop a little. The price-to-income ratio for housing, basically how many years of income a house costs, went from about 3.5 back in 1990 to somewhere between 7 and 9 now. The cost of entry doubled, just doubled. So if I buy in 2026 instead of 2002, I'm not just late to the game. I'm sitting down at the same table with roughly half the chips the person next to me started with, and somehow I'm still supposed to play it exactly the same way they did and expect the same outcome. Then rates went up in 2022 to fight inflation, and I thought, okay, finally prices have to come down now. They didn't. Not really. Instead, I got the worst possible combination. Prices that stayed high because sellers refused to sell at a loss, and borrowing that got expensive at the exact same time. People who bought back in 2015 are sitting on a house with a low locked-in rate and years of built-up equity. Why would they ever sell that to move somewhere else and take on a new rate, double what they're paying now? They wouldn't. So they don't, and the whole market just freezes in place. I found a listing near me and ran the numbers on the monthly payment against what I actually take home. 45 to 55% easily is what a median home eats out of median pay right now in most cities. I refreshed that listing 6 times before I finally closed the tab. 6 times. When I told a friend about the 45% number, she just kind of shrugged and said, "What can you even do about it?" And that's the trap right there. Most people either spiral into blaming the government, which is fair but useless, or they double down on the exact plan that already isn't working for them. Okay, that's the easy version of what's going on. Here's the actual version I had to admit to myself. The first trap is the credential trap, the idea that a degree is automatically the safest investment. It used to be, it isn't anymore, not the way it was for my parents' generation, and I only just accepted that. Back when a degree was rare, it worked like a filter that told employers you were different from most applicants. Now around 40% of adults have a 4-year degree. The signal got diluted just by math. When almost half the room has the same credential, it stops being the thing that sets you apart. I still owe money on mine, so this one hit differently. Average student debt at graduation sits somewhere around $37,000 to $40,000 now. I look at that number some nights and think about what else that money could have been doing for the last 4 years instead of just sitting there as debt. If your starting salary lands around $32,000 to $40,000 a year, the math on that debt gets brutal fast. Something like 12 to 15 years just to break even on paying it off, before you even factor in what else you could have been building with that time instead. 12 to 15 years. That's not a slow start, that's a hole. But here's what actually got me. The debt isn't even the real trap. The real trap is 4 to 6 years of not being in the market at all. Not building equity, not owning anything, just waiting in a holding pattern, while everyone who skipped that path got a 4 to 6 year head start on compounding. Second trap, and this one's harder to admit because it's basically my entire work ethic. The linear income trap. The belief that the way to build wealth is just earning more per hour. Work harder, get promoted, negotiate the raise. It feels like the obvious path because it's the most visible one. It's also got a hard ceiling. Even a doctor making $500,000 a year is still selling hours. So is a lawyer billing $800 an hour. The moment either of them stops working, the income stops with them. There's no version of linear income that keeps paying you once you physically stop showing up to do the thing. Compare that to the other kind of income. A rental property earns rent whether I'm asleep or awake. An index fund compounds while I'm doing literally anything else with my day. That's the actual difference between the two escalators. One needs my hours every single time, the other one just needs to already exist. This is the part that actually scares me about my parents' plan, if I'm honest. If your whole life is funded entirely by income and never by ownership, then the day the income stops, whether that's retirement or a layoff, the entire lifestyle stops with it. That's not a retirement. That's just a cliff with a nicer name. Third trap, and this is the one I'm most guilty of. The patience trap, telling myself that eventually rates will drop, prices will fall, the market will crash, and I'll just buy in cheap when it does. It sounds patient, it sounds smart, even. It's actually just waiting dressed up as a strategy. Corrections do happen, real crashes, real dips, but they're not scheduled, and when one actually arrives, it doesn't feel like opportunity. It feels terrifying. So most people wait for the exact bottom, miss it because fear took over, buy on the way back up, and then quietly congratulate themselves on timing they never actually had. Beyond the three traps, there's something bigger shifting right now, and it's moving faster than I expected. Artificial intelligence is compressing the value of knowledge work. Someone who knows how to actually use these tools can produce the output of a 5-person team alone. That gap between value created and what you get paid either goes to your employer or it goes to you if you own something. Here's the uncomfortable part nobody at work is saying out loud. Right now, companies are mostly capturing those AI productivity gains, not employees. You produce 5 times more, and your salary doesn't move 5 times. It barely moves at all. The linear income trap I mentioned earlier is getting worse, not better, as this keeps accelerating. Second force. Over the next 20 to 25 years, something like $70 to $80 trillion is expected to pass from baby boomers down to their kids and grandkids. 70 trillion. I wrote that number down and just stared at it for a full minute before I could even process what it meant for people like me. Whoever inherits real money in their 30s basically gets to skip the entire climb onto the up escalator. They didn't have to figure anything out. But most of us statistically aren't inheriting much of anything. We have to build the escalator ourselves from nothing. At the exact moment the cost of getting on it sits at an all-time high. Third force, and honestly this is the one that gives me some hope. Building wealth used to require capital first. You needed money to make money. A factory, a building, machinery. Now distribution is basically free. If you build something people actually want, you can reach people everywhere at almost no extra cost per person reached. A channel with 100,000 real subscribers is an asset. A newsletter with 50,000 engaged readers is an asset. Neither one needed a warehouse or a loan to exist. They just needed time and attention pointed in the right direction, which for once might actually be something I already have more of than money. Okay, here's the thing I haven't actually told anyone yet. I started writing all of this down not to vent, but because I needed to understand the structure before I could stop feeling powerless inside it. If you're the kind of person who reads other people's notes apps too, stick around, I write this stuff down regularly. There's a comparison I keep coming back to. 2 guys, both 23, both fresh out of school, both landing jobs paying $52,000 a year after taxes. Same city, same disposable income, around $700 a month left over. Completely identical starting point. What they each did with that $700 is where everything splits apart. One of them, let's say Marcus, does everything he was told, Savings account, $400 a month. Employer 401k match, $200 a month. Responsible, careful, disciplined. The other, Daniel, puts $300 into an index fund instead and spends 20 hours a week building a small business on the side with whatever's left. 5 years later, they still have almost the same salary, around $61,000, but Marcus has about $38,000 saved total. Daniel has somewhere between $90,000 and $100,000 because his side business started generating real revenue and he reinvested most of it. Same paycheck, completely different net worth. That gap only gets wider from here. Here's what people miss when they say most side businesses fail. Sure, they do. But if it fails, you've lost some time, not money, not your credit, nothing you can't rebuild. Compare that to working 20 hours of overtime for 18 months instead. Real cash, sure, but zero equity, zero asset, nothing left over once the hours stop. I know what someone's going to say to this, and it's fair. Not everyone starts with the same safety net, the same resources, the same luck. That's true and it matters. But knowing the system isn't fair doesn't pause the clock on it. The clock runs either way, whether or not I ever admit it's unfair. Here's the layer I keep circling back to. Every money decision I've made this year has been a reaction. Rent went up $95 in March, and I burned 2 weekends hunting a cheaper apartment instead of asking a different question. What do I want to own 3 years from now, and what would I need to build today to get there? Reacting feels like doing something, it's only running in place. Here's something that stopped me cold at my kitchen table. A small business in 1980 served its own town, maybe the next one over. That was the ceiling. Right now, from this same chair, anything I make can reach someone in Ohio and someone in Manila for the same cost, which is nothing. My grandparents needed capital to get leverage. I need a phone and something worth saying. Here's the part one, almost skipped writing down. 2 ways this fails, and I've already lived the first one. You build an audience for a year and never build a way to charge them anything, so you're sitting on attention with no machine underneath it. Or you build the thing you personally find fascinating, and nobody else will pay $1 for it. Get 10 people to pay before you chase 10,000. Stage 1 is clarity, and it is uncomfortable in a very specific way. I made a list of every hour in my week, actual hours, and for each one asked whether it would generate anything after I stopped doing it. Out of about 60 waking hours, one produced value that outlived the hour itself. 1. Everything else was time traded directly for a paycheck that stops the second I stop showing up. Stage 2 is experiments, and the rule is you do not quit anything yet. I'm keeping the day job, I'm keeping the paycheck, but I'm giving 5 hours a week, not 50, to something small and cheap that might build equity instead of trading time for cash. If it fails, I've lost 5 hours a week for a few months, not a mortgage payment. Most of these will fail quietly. I only need one to catch. Stage 3 is the one that actually decides this, and I almost failed it already. The first payment landed, $210, and my brain built a list of things to buy with it, starting with shoes I did not need. I'd earned it, technically. But every dollar spent now never compounds, and every dollar reinvested buys speed on the escalator later. I put it back in. It was harder than it sounds. Stage 4 is the one I have not earned the right to worry about yet, but I'm writing it down anyway so I remember. Once one thing works, the money doesn't all stay in that one thing. Some goes into an index fund, some into whatever else proves itself, because anything you build alone can go to zero, and industries shift overnight. Diversifying isn't fear. It's math protecting itself from a single point of failure. Here's the layer that made me feel a little sick when I finally saw it. Housing, stocks, and jobs are not 3 separate systems bumping into each other by accident. When asset prices climb, people who already own things feel richer, so they spend more and invest more, which keeps the economy humming, which keeps prices climbing. It's a loop that feeds itself, and it rewards people already inside it. Nobody is conspiring. They are responding to their own balance sheet. Here's why I stopped expecting anyone in office to fix this for me. Most voting-age adults already own property, and property owners do not vote for policies that shrink the value of the biggest asset they hold. A politician who genuinely deflated home prices would be punishing their own base on purpose. That is not a conspiracy theory. That is an incentive, plain and read out loud. The people who could change this benefit from it staying the same. Here's the part 1, keep avoiding writing down because it means giving something up. For 2 years, I told myself I was waiting for the right moment. Rates dropping, prices correcting, some clean entry point that would make the math finally make sense. That moment is not on any calendar. Structural relief at the scale I'd actually need is not arriving on a timeline that helps someone my age right now. Waiting was never a plan, it was a story. I did the honest math on my phone last night, the version nobody puts in the caption. $300 a month into an index fund at 7% for 40 years lands around $800,000 by 63. Inflation eats that down to something closer to $250,000 in today's terms, and I'd still be 63, dependent on 40 straight years with no gap, no health scare, no layoff. That's not freedom. That's fine if fine is enough. So here's what I'm actually doing instead of only journaling about it. First, I'm tracking my leverage ratio, how much I make while working divided by how much I make while not, and trying to move it up a little every year. Second, I'm building one asset in the next 12 months, something that keeps working after I close the laptop, even if the first attempt fails. Third, I'm done treating my grocery budget like the main lever. I started all of this because of one number that would not leave me alone: 14 years of full salary to buy an ordinary house. I want to end on a different number. One decision made early with decent mechanics behind it can outweigh a lifetime of doing everything exactly right the slow way, not magic, compounding. I'm still sitting here with my phone, the math still open in the Notes app, and I still don't know which decision that is for me.